Greetings. We are excited to introduce our online e-courses, designed to teach entrepreneurial skills to handcraft women as part of the KA 220 Project UGO. We are a team of 5 organizations, including Ageria Desarrollo Social, Impact Circles, Aquilia, Effectus Group, and MB International, working towards empowering women in the craft industry. This e-course is a part of Module 4, where we focus on sustainable finance and sponsorship. In this course, we cover the essential concepts and practical tools necessary for understanding tools to finding a funding opportunity. Thank you for joining us in this exciting journey. Unit 1, Sustainable Finance. Topic 1, EU funds and programs. Depending on the country, small businesses can apply and sponsor their startup. There are loans for new small businesses with very low interest rates. The development of trade behind which stands the production activity is viewed positively for the needs of EU projects and microloans from various government bodies. Topic 2, Support for self-employment. It is given to unemployed persons to cover the costs for the establishment and startup of a business entity. The goal is financial support, and the amount of the subsidy and the duration of the measure depends on the countries. Topic 3, Loans and microloans. Microloans are small loans that are intentionally designed to help meet the needs of startups and small businesses that may not qualify for funding elsewhere. One of the opportunities is to acquire microloan from a certain government body in the country where the webshop is located. There are community organizations, nonprofit groups, online lending platforms, and individuals that offer microloans. Resources, training, and business advice are often part of receiving a microloan. The loans are designed to help startups and small businesses grow and succeed. Topic 4, Investment funds. An investment fund is a product that combines the savings of many people and then puts them in the hands of a team of investment experts, the fund managers, so that they can make the money grow. Advantages of investing with other people are, you can do things that you would not be able to do with your savings, you gain access to professional managers that would otherwise cost you a lot of money to hire. You have a more balanced portfolio for less money. Taxation is one of the great advantages of investment funds. Funds are a product that allows tax deferral. Disadvantages are market risk. The risk is the possibility that the value of the asset may fall, and selection of funds. There are many funds and not all of them are the same or even good. Topic 5, Business Angels. A business angel is a private individual, often with a high net worth, and usually with business experience, who directly invests part of their assets in new and growing private businesses. Business angels can invest individually or as part of a syndicate where one angel typically takes the lead role. Besides capital, angel investors provide business management experience, skills, and contacts for the entrepreneur. Experienced angels also know that they may have to wait for a return on their investment. They can, therefore, be a good source of smart and patient capital. The positive side of business angels is that they provide valuable knowledge, expert support, contacts, and guidance. Their experience and resources can be of significant value for businesses' growth. Also, unlike banks, business angels fund businesses or entrepreneurs with the money they need to get going, getting an ownership stake in the company in return. This ownership stake starts at about 10%, there is no repayment required. The negative side can be that business owners commonly give away between 10% and 50% of their business startup in exchange for capital. They can encourage you to sell your startup before you're ready if the business fails, but they can also choose to hire a more experienced executive and remove you from the company. Furthermore, it is essential to evaluate whether the company can grow at the rate that an angel investor expects and determine expectations for growth. Topic 6, Corporate Social Responsibility. CSR is understood to be the way firms integrate social, environmental, and economic concerns into their values, culture, decision-making, strategy, and operations in a transparent and accountable manner and establish better practices within the firm, create wealth, and improve society. CSR is an entry point for understanding sustainable development issues and responding to them in a firm's business strategy. It can involve a wide range of stakeholders, non-governmental organizations, business partners, lenders, insurers, communities, regulators, intergovernmental bodies, consumers, employees, and investors. It can also help in finance, building share value, lower the cost of capital, and ensure better responsiveness to markets. Potential benefits of implementing CSR include better anticipation and management of an ever-expanding spectrum of risk. Considering the interests of parties concerned about a firm's impact is one way of better anticipating and managing risk. Improved reputation management. Reputation is founded on values such as trust, credibility, reliability, quality, and consistency. Enhanced ability to recruit, develop, and retain staff. Improved innovation, competitiveness, and market positioning. Enhanced operational efficiencies and cost savings. Access to capital. Thank you for watching our e-course on the topic of sustainable finance. We appreciate your interest in expanding your knowledge in this area. If you are eager to dive deeper into this subject, we invite you to explore our additional resources.